Sandeep Bhatia now is joining us, Managing Director and Head of Equity India at Macquarie Capital. Sandeep, good to have you with us here. Thanks very much. Let's just start with that pharma question. And then maybe we can pedal back and talk about the bigger 25% plus penalty question as well. But pharma, your sense, Sandeep?
Good morning, everyone. I think pharma raises multiple issues. One is the immediate issue of whether SunPharma and some other innovator drug companies will get notices like what the Swiss and the other multinational companies have received from the Trump administration. In the last quarterly conference call, my analyst says that SunPharma, which derives around 20% of its revenues from innovative drugs sold in the US, said that they had not received any such communication. But this is anyway, with the Trump administration, everything is work in progress. Everything can change. Even when things are moving in a certain direction, they can move suddenly in the other direction. So that's where we are. So right now, there's a fear that this most favored nation treatment for Medicaid and other US administered medical programs, the pricing of that should match the pricing which the companies charge in other wealthy developed nations. So clearly, there's potentially a pricing pressure that can emerge for the US supplies. So that's where the worry is from. We need further clarity to make a real judgment on whether this is what it is, or whether even I would say that many things can be mitigated by lobbying, and whether, because this is a very industry-wide issue, as correctly pointed out by you, whether this will be lobbied away.
Sorry, that's an interesting point, because so far we are looking at US generics into the US, but you're saying the thing to look at, the metric to look at is exposure to innovator companies, right?
Yeah, so innovative, as far as India is concerned, right?
Yeah, absolutely. So Sun, your analyst is saying Sun's exposure to innovator companies like Pfizer, Merck, Eli Lilly, etc. is about 20%.
Innovative drugs. So that's what I'm saying.
It's about 20%.
Yeah.
So that is the number we need to pull out, and we'll do that and put that up as well, because that is the new part. These letters to innovator companies to reduce what they charge US consumers, and in turn, if these sort of innovator companies pressure their suppliers, right, like Indian Generic and others around the world as well. Surabhi.
Okay, so pharma definitely a watch point for sure. Sandeep, hi, good morning.
But remember, everything can be lobbied in this administration.
Yeah, everything can be lobbied.
Lobbying, negotiation, pressure. We've almost run out of adjectives to describe this on a daily basis. But Sandeep, morning, the rest of it also doesn't give a very happy feeling, right? And the market's been reflecting that. That's why the slow grind all through July, because anyway, those global tariff headlines are not very supportive in terms of India sentiment. And then you have our own earnings issue. What is your read-through of Q1? I mean, there's no single sector which can really spark off, anyone's imagination. It's not there in IT. FMCG maybe. I mean, people are now hoping that, look at Lever today, for example, this morning. So tell us if you think FMCG can be that safe haven that the market is desperately looking for.
FMCG can be a safe haven is a strong word. I think we need at least 6 months at the very least. I would think 12 months of strong volume growth, which comes to at least 6 to 7%, at least in the line of GDP growth. We are not there. Hopefully, we can get there by the October-December quarter. So that's where it is. I think the real challenge is at multiple levels. If you look at it, the market has continued to re-rate, and that's been the primary driver of the market strength, which is just the PE multiple expansion. On the other side, I would think that the retail participation is a good thing, but we know for a fact that fundamentally stock prices should track earnings, and we have seen earnings lag. So would I mind if there's a sideways or even a correction of 10%? I would absolutely don't mind that. A correction is actually welcome.
But that's my question. That's precisely the question that I wanted to ask, Sandeep. That as you see it from your vantage point, the next 6 months, are you looking at a time correction, which perhaps is not that bad then, or that price correction, like you said, 10% downside?
I would be in the camp of a time correction, just for the technical reason which I was just elaborating, which is the strong retail flows. A price correction is actually more welcome than a time correction because you get done with the pain very quickly. A time correction can be 6 months or even more than a year. And that's actually more painful for the market. A quick and sharp 10-15% correction is what is better from a market perspective. That depends on whether we see any big incremental bad news. I think the tariff news which came out yesterday is not actually that kind of a trigger for the market to correct 10-15%. So we'll wait and see if there are more bad news coming out which can correct the market.
All right. So the low of the year at least will get protected, that 21,700 that we saw earlier.
Sorry, I didn't hear this. Your voice was very, very faint.
The low that we saw, Sandeep, earlier this year was around 21,700. So even though the earnings haven't been very, very great, a lot of...
I'm still not hearing that. Someone else can repeat that question, please, because the other two anchors do better.
Yeah. So Sandeep, Nigel's basically saying that we're just trying to, clutch on to all optimism here. Since you're saying the likelihood of a time correction is more than a price correction, so at least the lows of the year should be protected.
I would think so, but I would actually recommend a price correction. Is the sentiment I'm expressing, that a quick price correction would be more welcome than a
better. Okay.
Yeah, but I take your point. I mean, but we have to see, Sandeep, the flows also, and I track that data on a monthly basis. And thankfully, those SIPs are very steady. But overall flows have halved from 40,000 crores. Now we're tracking, 26,000 crores on a monthly basis. But in this kind of an environment, okay, then in this new normal, which would be the sectors where you would park if anyone has additional money, if anyone's looking at, deploying, where should the money go?
I think I would look for a couple of triggers in the market. I would want to see where we are in terms of the US Fed rate cut cycle. I would definitely think that we would see one rate cut coming through from the US this year, probably around the big shopping period there, which is the October-November Thanksgiving period, pre-Christmas. That actually means that we could also see a rate cut. That's not something which everyone talks about, but I would think the likelihood of another 25 bips rate cut post-Diwali for India is increasing, especially if the US cuts rates. So in that sentiment, I would think autos look interesting. We will definitely see consumption impetus in the October-December period. That's the base case that everyone's working on. But the larger high-value autos could see, therefore, improvement if there's one more rate cut. We have seen a 100 basis point rate cut till now, and we could see another for the year, and we could see another 25 basis point, which would be good for consumption, especially for large ticket items like autos. All
right, Sandeep, I hope I'm audible now.
Yeah,
what about the hotel space? The last time around we had a chat that that's a sector that still looks good. Now, some of those numbers in the first quarter have been a little bit soft, but as we heard Mr. Puneet Chhatwal, he was saying that actually this year is going to shape up extremely well, and there was a lot of confidence in his tone as well. Do you think that's still a sector that you would look to get into?
Yes, I think autos is the quasi-consumption kind of story, FMCG, which we were discussing at the beginning of our conversation, but it's a faster growing and more stable. The last quarter was anyway expectedly weak with all the negative outcomes on air travel, crashes, and so on, and the war. But this festival season, again, high-ticket consumption like autos and travel could definitely see impetus come the fourth quarter, and hotels, therefore, would be a big beneficiary.
Okay. And so hotels and hospitality continues to be a space that Macquarie likes. So remember that. We'll keep that on board. Thanks for joining in, Sandeep. Good conversation. You have a good weekend, and we look forward to connecting again soon. Well.